How is it going, everybody? I'm Aman from Cloudiverse CPAs. As you all know, the RRSP deadline is quite near, which is March 2nd, 2020. I wanted to share some useful information through this video. Let's start this video with the basics. The full form of RRSP is the Registered Retirement Savings Plan. I know the name kind of says savings plan. You may be thinking it is kind of savings account, like a high interest savings account of some sort. But the RRSP is actually an investment account. So very similar to the TFSA. It's just one of the options that you have, and each of these investment accounts have their own unique characteristics. But one of the major benefits is that it is a tax sheltered plan, meaning that any income that you earn within an RRSP, you don't have to pay taxes on. And that's why you'll commonly hear people say it's like a tax-free savings account, because it's actually sheltered from tax. To explain what I mean, let's use the example of Apple, okay? You own one share of Apple, which you bought for $100, and it goes up in value to $200. Your stock has grown by $100. If you go out and sell that stock, you have earned yourself a $100 return, which is called capital gain. Now, if this stock was held in a cash account or in a margin account, or what we would call a non-registered account, unlike on a sheltered plan, you have to pay taxes. And the way it works is that you would take 50% of that gain. So in this case, $50, and that $50 would have to be included in your taxable income. And you'd have to pay tax on that at the end of the year. Now, if you held the exact same share of Apple in your RRSP, the same stock, it made the same gain, but instead of holding it in a non-registered account, say you held it in your RRSP, the entire $200 is going to stay within the plan, and you don't have to pay any taxes on that. Then this goes for any income that you earn within the RRSP. That is capital gains, dividend from your stocks, interest that you are receiving from bonds, etc. You see, that is what we mean when we say it is a tax sheltered plan. So you can see already just how valuable that is when you think about all the money that you're going to be saving in taxes, which gives you more capital or more money to invest and compound over time. Now, on the top of being a tax sheltered plan, which is amazing, the RRSP is unique as it's a means of deferring tax as well, meaning you are not going to pay tax now, as you are going to defer it, as you will pay the taxes later. You might be wondering how the tax can be deferred. Well, the amount of money that you contribute to your RRSP can be deducted from your taxable income. I know that probably does not make a whole lot of sense, but we will go over an example in just a second. But before we go into that example, we have to understand how taxes work. So for anybody that works here in Canada, if you have a job and you are making money, well, you have to pay income tax on that right at the source. And the government is going to get a chunk of what you are earning now, which means that at each paycheck you receive, your employer withholds a little bit, and you've probably seen at the bottom of your pay stub that you have deductions like withholding tax, CPP contributions, and that is why looking at your paycheck, you have your gross income, but after the deductions, after the tax and whatnot, you actually end up netting less. So basically what happens is that throughout the course of the year, each paycheck, they are taking a little bit off, and that should add up to the amount that they estimated that you should be owing in taxes. Now, if they took too much, which happens, they are usually pretty close, but if they took too much, you are gonna get that difference back through your tax refund. On the same token, if they did not take enough tax, well, you'd actually be owing. So that is kind of how the tax system works, and that's important to understand when it comes to RRSP contributions. You might ask, how does your RRSP comes into play here? Well, like I said, contributions to your RRSP can be deducted from your taxable income. So looking at the example, let's say here of Bob, let's assume that he's making $40,000 a year. And if he gets taxed at approximately 30%, that means that he owes the government $12,000 in income tax. Now again, if with each paycheck, they'll be taking a little bit, and it should add up to $12,000 through the course of the year. Now, if Bob makes a $10,000 contribution to his RRSP, he can deduct that amount from his taxable income. He does not need to make any investments. He can literally just pop the money into that account. It can be sitting there in cash, and that will count as contributions, as cash in the bank account, GICs, mutual funds, and securities traded on designated exchange are all qualified investments. However, beware that there are significant negative tax consequences to holding investments that are either non-qualified or prohibited. These include shares of private corporations that the shareholder holds a significant interest in. Second, commodity and futures contracts. Third, personal property. Fourth, precious stones and gems. Let's come back to our example. So Bob deducts $10,000 from his taxable income, and his new taxable income in the eyes of the CRA is now $30,000. So when the government wants to tax the 30%, well, he only owes $9,000 in taxes. But again, throughout the year, they've been deducting about $12,000. So at the end of the year, he's going to get his difference back, in this case, $3,000 as his tax refund. So simply by putting money into your RRSP, the government rewards you, saying, hey, you can save some money on taxes now. Well, there is a caveat to this. Please remember, this does not mean that you will never pay taxes. Remember, you're deferring those taxes. So when you take money out of your RRSP, you have to know, you have to include that amount in your taxable income for that year. And the whole idea behind deferring the taxes is that during your high income years that you're working, you're likely to be in a higher tax bracket. You can use the RRSP, you can save the money on taxes, that gives you more money to invest. And then ideally, years down the road, when you are in retirement, there is a high probability that you will be in a much lower tax bracket. That is when you start peeling the money out, and hopefully you are paying a much lower amount in taxes at that time. You see, you can take the money out of your RRSP whenever you want, okay? But you have to pay tax every time you withdraw money from RRSP. Please also remember that you have to start taking money out in the year you turn 71. When you turn 71, we recommend you to convert your RRSP into what's called an registered retirement income fund. Well, there's going to be a minimum amount that you have to start taking out. So eventually you are going to have to start paying taxes on these withdrawals at that time. There is another circumstance where you can take money out of your RRSP, and this is through what is called a home buyer's plan. If you are looking to go out and buy or even build a house, you are eligible to withdraw up to $25,000 from your RRSP. And this withdrawal can be made tax-free now. This withdrawal should be for a qualified primary residence house located in Canada, and you have up to 15 years to repay that amount to your RRSP. So you are essentially taking a loan out from yourself, from your RRSP account, assuming that you are willing to pay it back. Important thing to remember is that your RRSP does have contribution limits, okay? So you cannot pile as much money as you want into these accounts. The RRSP deduction limit is 18% of income earned in the previous year up to a maximum amount of $26,500, that is in 2019, minus any pension adjustments or past service pension adjustments, plus any pension adjustment reversal and unused contribution from previous years. For example, you made $100,000 in 2019. Well, the amount of space that you have available would be $18,000. Now, if you don't use the full space, that's completely fine. It's cumulative, so each year the space that you don't use is going to add up, building up more and more space. If you are curious to check out what is your personal limit, you can check your federal notice of assessment for the previous tax year, or log on to the Canada Revenue Agency's My Account to find out your RRSP contribution limit for the current year. Some of my clients ask me, why does the pension adjustment needs to be deducted? Well, if you contribute to a registered pension plan like through work, that does cut into your RRSP contribution space. The CRA does not want you to do double dipping. They don't want you putting 18% in your RRSP while having money piling up in registered pension plan as well. It's going to be capped out at 18% as a combination of both. Remember that not all income is earned income for the purpose of RRSP room. Some of the income that is considered passive in nature does not count as part of the earned income. Some examples are income from pension plans, regular payments from Canada Pension Plan, old age security, withdrawals from an RRSP or registered retirement income fund. Investment income such as interest, dividend, or capital gains. Another question which my clients frequently ask when thinking about maximum contributions is, what exactly qualifies as earned income? The most common types of earned income to accumulate RRSP room include the following. Number one, net employment or business income, including income from a partnership, net rental income less any rental losses, Canada Pension Plan or disability pensions, spousal support payments received less any spousal support payment made, royalties. Just a fun little fact here. If you have these resources and have maximized your investments in a tax-free savings account, you may want to consider making an over-contribution to your RRSP. The Income Tax Act allows you to over-contribute up to $2,000 in total without the penalty to your RRSP. But you cannot deduct the over-contributed amount from your income in the year that it is contributed. So, for example, if you had, let's say, $18,000 worth of room, technically you could put up to $20,000 without getting into trouble. But if you were a dollar over, which you don't want to find yourself in that situation, as you are going to pay a penalty of 1% per month until you get that fixed. So that does give you a little bit of wiggle room. It's just something to keep in mind as you make your contributions. If you do not have cash available to contribute, you can also consider borrowing the funds to contribute, especially if interest rates are low. It may make sense if you can repay the borrowed funds within a short period of time, typically within 1 year, or if your income for the current year pushes your marginal tax rate into a higher bracket than usual, which would result in a potential deduction at higher rates. Remember that borrowing money to buy securities involves greater risk than buying using cash. If you borrow money to buy securities in an RRSP, you are still responsible for repaying the loan and paying interest even if the value of the securities purchased declines. If you borrow to invest in an RRSP, the interest is non-deductible, and this may partially remove the tax benefit of the contribution. You may find it more effective to make regular monthly contributions to an RRSP rather than make payments on a loan. If you take money out of your RRSP, you don't get that contribution space back. So unlike TFSA, in which if you take money out the next calendar year, you can put that back. Well, with the RRSP, once you take the money out, you can kiss that space goodbye. So again, just something to keep in mind. You see that the contribution space is based on your deposits. For example, if you have $10,000 worth of room and you deposit $5,000, if those investments grow to $10,000, or let's say even if they grow to $100,000, it does not matter. You're still going to have, in this case, $5,000 worth of space left. It's not about the growth or the size of your portfolio. Your contribution space is determined by the amount of deposits that you make. I hope you found this information useful. For more tips and tricks, please visit our website, the link for which is in the description of this video. Our YouTube channel contains a series of short videos which highlight some core tax planning tips which are instrumental in helping you to save taxes. The videos are yours to view and share for free. No obligations or strings attached. If you want to be notified about our new content, please do consider subscribing to our channel. Thanks for watching and see you next time. Bye.